Hi, I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network. Today we're going to look at the EIA and really drill down what's been happening. Now we're doing this a little bit later, so we have the ability of a little bit of high insight. So we've seen the fact that crude has rallied. So now that we look at and we try to start just really jumping right in, looking at what is the crude stock build. So right now we have the crude stock build came in at about 10.04 million once you include the SPR. Now, it's important to understand, what does that mean? Where are we looking at? And pad 3 is the big one. Pad 3 had a big build of 10.25 million, and that was really driven by a lot of the crude coming off the water and into storage. At the same time, we also have Cushing. Cushing, we had a big drop, but all of that oil is now pushing down into pad 3 because we have space, we have some capacity, even though we're at all-time highs. Now, just to kind of wrap up, if you look at just this specific slide, when you look at the crude oil production, it shows that we're only down to about 11.4. But when you look at the actual supply data, the EIA is actually discussing a 1 million barrel drop. So that's really at about 10.4, which is about where we are at this point. We think 10.4 is the near-term bottom, just because we're going to get some shut-ins coming back online. We're going to have some normalization. So we will get a little bit of a bounce, and it'll be a little sticky before we kind of continue down that drop. Now, to really dig in and understand, well, what is happening in Cushing? We got really close to those tank tops, and then things really kind of rolled over. We should continue to trend lower, just because Cushing is just a delay point, where you really want to get to where the refining assets are, and the refining assets are going to be operational more in pad 3. So Cushing is no longer going to be a place of interest, where pad 3 or the Gulf of Mexico is going to be the focus. Which is why when you go to the next slide and see, oh, well, this is pad 3 inventory, you can see that we've seen this massive increase, and the increase is going to continue over the next couple weeks as we have more crude directing into the Gulf of Mexico, and we also have more imports coming off the water, specifically into the Gulf of Mexico. Now, the other two places that are also seeing imports, one of them is interesting just for the later topics, is pad 5 or the West Coast. So the West Coast is also going to see an increase in imports, but it's going to be slow to be rational or to be realized, just because refiners remain very low on the utilization rates, just because driving demand continues to be very low. Now, when we talk about driving demand and we talk about imports, you can see the pad 3 imports increased 1.34 or so million barrels a day. And that's just the Saudi crude that we all have been talking about, I've been talking about, has been coming on and has been transitioning from floating storage, from oil in transition into the tank. Now, the big focus is on how do we look at this on the big picture. And we'll talk about this more tomorrow. When you're looking at floating storage has transitioned away from the Middle East and has gone into both Europe, the US, and Asia. Now, West Africa saw a decline in their floating storage, but it has now increased because they're trying to play the curve. And that's why imports are going to be important, because we continue to see those imports rise. This is a high, we're going to pull back just because there's delays, there's timing, but we're going to see an elevated amount of imports, which will have to be married with runs. So we talked about how we thought runs were going to increase to about 75% through summer driving. We had an increase of about 1.9%, to get you at about 71.3. We think that for this week, as we go forward, we're going to get to about 73%. And it's really going to be driven based on pad 3, and which pad 3, again, the Gulf Coast, just because you're going to have a little bit more rationalization with the imports coming in. Now, implied demand is important. It's a calculated number. I get it. We're going to do a deeper dive looking at some other metrics and some of the write-ups that we do, but it's a good point of reference. And you can see it continues to fall on a holistic level, but also gasoline had a bump, which it should. It was Memorial Day weekend. it's still grossly under where we should be at this point in time, which is why when we look forward, we believe that gasoline demand is going to normalize a little bit higher, but again, not at levels we've seen. It's going to be well below. And distillate, which is the driver of the economy, continues to fall. And that's something that we're going to see. But again, we have to consider these things under the seasonality, because seasonality is so important, because you can't compare summer to a shoulder season just because nobody's driving as much in March as they are in July. So when we look at the crude oil imports, you can see that they're trying to marry them. So by marrying, you need to import the crude as we increase those runs. So the runs are going to be important because they have to change the feedstock. You have to change the feedstock, which is the crude that goes into the refiner up into the system, in order to really create the product that's going to yield the most value, because crack spreads continue to struggle, continue to point to really low demand. So that's why when we look at the utilization rates, we can see that we're still near Harvey levels, and that's going to continue because the refiners just aren't making money. If you consider it from this perspective, if you normally have a fixed cost of say $3, and that was when you were operating at 90 to 95%. Well, now you're operating at 70%. That means your fixed cost went up per barrel because there's just less barrels to spread it across. So not only is your cost increasing, but also the money you are realizing on what you're selling the product into continues to struggle. We have gas oil near lows. We have gasoline prices paring back. But the big struggle is just the overall total crack. There is very little places to make money on any product, which is why when we look at what is going to drive this going forward, we continue to focus on distillate. So when we look at distillate, you have the huge pullback, seasonally adjusted, just because you have to consider where distillate goes into, which is also heating oil. So here you have a big move lower. This is something where we're going to get a little bit of a normalization down here, but it'll still remain at 5-year lows. The big one, and I say big just because a lot of people continue to point to it, is gasoline. Gasoline, we saw the bounce, but Gas Buddy and a lot of these other companies that are looking at real-time traffic data, because when you look at the total gasoline supply by the EIA, that goes to the rack. That's not what's at the pump. That's just going to where the trucks load up to take it to your local gas station. But what are people actually doing? What are the miles driven? What is the actual gasoline being consumed? And it was all down 2-3% versus the week prior. But again, the comps are tough because the comps are only going to get harder as we go into summer driving season, which is why we just think you're going to get this huge amount of pressure. Because let's look at Memorial Day. People stayed local. They didn't go across state lines. They didn't even really go across town lines. They stayed within their local region, which is going to be something that's going to continue even as you start to open up. And when we take this and think, okay, well, we've talked about demand, we've talked about imports, what about exports? Exports continue to struggle. And this is because Latin America continues to fall, and Europe continues to see builds within their own components. They had builds across gas oil, across gasoline, jet fuel. Jet fuel on a global level is at like a 12-year high. And this is even when you're dumping it into other forms of gasoline and distillate. These are going to struggle. These are going to continue to be a headwind. And if we're not exporting, it means that we're either keeping it in the local tank or we're sending it into other regions. We talked about crude oil exports falling. That's going to continue. We think that over the next 2 weeks, we're going to fall below 3 million barrels a day, which again is just going to push more into the PADD 3 tank. And when you consider what is being exported, you have to, again, the seasonality is key, and we're bumping along the bottom. So when you look at gasoline exports, they continue to reach those lows, and it's because the Middle East is sending more product into our typical markets. The Middle East is going into sending product into Latin America, and India, of all places, in China, are sending product into Europe as well. So we're just losing our normal export regions, which again is not just being reflected in gasoline, but is also being reflected in distillate. Now, distillate is going to have a little bit more support just because we've had some shipments get sent over into Europe. But again, that's just it's a one-time deal at this point because India continues to be continues to send more shipments into our typical markets. Now, rounding it up, you have to look at gasoline draws. We had a small draw of about 720,000, and it was really driven based on Pad 3 and Pad 5. That's going to change because Pad 3 is ramping back up. You had a little bit of a price premium that opened up between the Gulf Coast and the East Coast. So you had some product move up. But again, those are things that are going to struggle going on just because crack spreads aren't there to support longer term. Distillate continues to be a huge build. We 5.5 million or so across the board, which again is going to continue to increase as exports struggle. And at the same time, you need to put the jet fuel somewhere, and jet fuel storage is really roofing, really maxing out. So distillate is going to be the focus because that's the easiest place to put the kerosene. It can also go into gasoline, which is also going to see an increase. So between the distillate and gasoline, that's going to be where a lot of the jet fuel or kerosene is going to get dumped over the next, foreseeable future, really, just because, I don't see jet fuel or airplane travel really increasing meaningfully over the next, several months, or at least into 2021. So we're going to focus more on some of this on a global level. We're going to look at why we think prices are going to remain depressed. We had the crude pricing increase today, which again, there's buying pressure, there's momentum. And at the same time, there's some bullishness in the sense where you have less production, that is being shown, that those are things that are going to provide some support. But again, the refinery utilization rate, the lack of demand, the lack of money being made is going to keep long-term demand pressures at bay. So I think that after this run, which could probably take WTI Cushing to 35, 36, really starts to pare back, and we see a pullback that goes back into the mid-20s. So what we're going to talk more about this and more about the global geopolitical. We're going to talk on China, India, what's happening there on an energy level, but also geopolitical. And we're going to, again, focus on our favorite topic, the primary vision frac spread count. So I'm Mark Rossano, CEO and founder of C6 Capital Holdings. Thanks for watching. Please subscribe, ask any questions. We love interaction, and we'll talk to you soon. Thanks.